Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Welcome to the latest ASB Investor Podcast. I'm Chris Tennent-Brown and I'm joined by Victoria Harris, who is a portfolio manager at independent investment specialist firm Devon Funds Management. Victoria's been my guest on a podcast we did earlier this year about the local share market, and she had some fantastic insights, so we've invited her back. We're going to reflect on the year that's been for the New Zealand economy and share market and share some thoughts on the outlook for 2022. So welcome to our virtual recording, Victoria. How are you going?
Hi, Chris. I'm good. How are you?
Oh, not too bad. I'm probably a little bit tired of being at home, but you're back in the office for a few weeks. How's that going?
Yeah, no, it's good. It's surprising how quickly you can revert back to normal. I went to a restaurant this weekend as well, and it was it was quite interesting. Yeah, how quickly you can get used to being waited on at a table again, and everything kind of reverts back to normal pretty quickly. So, yeah, it feels like we've been back in the office for a while now. I kind of miss working from home. Dare I say it?
Hey, well, I'm still working at home, so I'm very much looking forward to getting back into the office. But, I've had my first meal out and over 100 days on Friday. And actually, like you said, it just felt surprisingly normal. The same as just a little local place, and actually the staff were the same. Some of the guests there were the same, and we thoroughly enjoyed it. The only thing that was different was my stomach had definitely forgotten how to eat lots of rich food and desserts and things. So I definitely felt like I'd eaten too much once we got home. But hopefully all of that stuff will become a bit more familiar. And as we roll into Christmas, my stomach's definitely going to get a few more challenges. So
Same here.
Yeah, it certainly feels like we're in summer, and it's nice to see things reopening. And just for some background for our listeners, you've got a stack of experience in financial markets about over the past 10 years or more, but we'll really tap into your expertise on the local market, because people have been saying, what's behind this uncharacteristically flat year for local shares? But we'll get some insights into what's going on in Aussie as well, because at the end of the day, we do tend to treat Australasia as and one investment market when we're building a diversified portfolio. So we'll touch on some of that stuff too. Hey, so let's start with a big picture question. Of all the years you've been working in markets, how would you rate 2021 in terms of challenges?
Yeah, well, definitely a challenging one. I think 2020 was the year that gave me the most grey hairs, and then 2021 was the one that probably kept me the most busy in terms of I guess coming out of COVID, so much to navigate, still so much uncertainty and unknowns. I guess also it was a challenge because I constantly had to question myself. And I think as soon as you think you have got some certainty, the pandemic really kind of threw that into disarray again, and that was reflected in the volatility that we saw in the share market. We also saw a lot of acceleration of trends, and constantly asking ourselves, are they going to continue? Rotations back from value to growth, and then also from these kind of stay-at-home to vaccine beneficiary baskets that we like to call them. So there was a lot of rotation under the hood going on, and we've also got a whole lot of macro factors, a lot of government stimulus, and then government stimulus rolling off, and it was. I guess for me personally, it was. I mean, I've been doing this for 10 years, but it's been 10 years of a bull market. So it's been, I wouldn't say easy, but it's been, a lot more seamless. And I think the last 2 years, so 2020 and then 2021, have definitely taught me a lot in terms of the benefits of being an active manager and needing to, I guess constantly come in with a fresh set of eyes and look at markets objectively, and I guess just pull in a lot more factors in terms of when making decisions about what to invest in, really. Yeah,
I think those are really interesting comments, and I found going back for my career, I've had a few plunges in the late 90s, early 2000s in the GFC. And 2020 was really scary at times for investors, and it really challenged me because markets fell so far. But ultimately, it was really rewarding for people that stuck with their strategies. And for my job as an economist and a commentator, to see that happens really rewarding because people ultimately get benefits that they can see. Whereas this year's just been confusing.
Yes,
Firstly, because our share market's been so out of sync and just really gone sideways. And secondly, normally we look at equity markets when we're looking for reasons why portfolios might be down, but with this very rapid increase we've seen in interest rates, that's hard to explain as well. So this has just been a challenging year to communicate with investors about what's been going on with markets. And like we were talking about before, working from home's gone from being a novelty to quite a challenge.
And I think it's also made us realise that you need to stick to your knitting in terms of investing in quality companies and taking a long-term view, because you never know what's going to be around the corner, whether it be short-term volatility or a global pandemic. And I think it's really made me realise that, yes, you say you invest for the long term and then, you can jump in and out of things pretty quickly, but it's really making sure that, you stick to the winners, I guess, and hold on to those quality companies that will most likely come out of this a lot stronger. And so it was just really kind of sticking to your gut and investing, for the long term as we should.
Yeah. And likewise for someone with a diversified portfolio or a KiwiSaver account who I always say, hey, well, you've got through this year, and if you've got 20 years before retirement, I don't use the word guarantee lightly, but I will guarantee that there'll be other periods over the period of your savings lifetime that you'll experience some moments of weakness in markets and volatility that's uncomfortable. So sticking to your knitting, like you say, and hey, that was one of the things we talked about in the last podcast was some of your investment maxims that you use, and so I was interested to know, how's the Curve, your investment education platform for women, and your own podcasts going? Has the lockdown stuffed that up for the time being, or what's happening there?
Yeah, it's definitely, we've definitely had to pivot and adjust to lockdown. It obviously came as a surprise to everyone and to us in the Curve as well. We obviously hold live in-person events. They're kind of our bread and butter. We couldn't do any of that, so we pivoted online, which was actually quite amazing. We saw a huge response in terms of attendees outside of Auckland and outside of New Zealand even, which kind of has blown us away. So it's might have disrupted things in the short term, but we've actually been able to reach a lot more women across New Zealand and in Australia, which is great. We were able to get into the studio and record, so we have launched season 2 of our podcast as of last week. So that's coming out. And I think COVID's just really given us a lot more to talk about as well. It's also made people, obviously it's in the headlines and people are concerned and worried, and it's really just made us, I guess hone in on what we've always said, like I just said, in terms of investing for the long term and taking that long-term view. And we actually did some stats around the New Zealand market, and in the last 20 years, there's only been 5 years that the market has finished down. And, when you put that kind of in perspective, people get less concerned about a year where the market has underperformed. So, you kind of say, okay, well, you've got 15 years of good years and 5 bad, and in the scheme of things, that's not too bad. So, we're looking forward to getting back and having in-person events, and it's pretty busy in terms of what we've got in the pipeline. So, hopefully I'll get a little bit of a summer break over Christmas, but we've just been blown away by the interaction and the response to date.
Oh, that's good. We've done the same thing. Pivot seems to be a term we use when we suddenly have to change to something we hadn't thought of before. And we've had some pretty decent-sized virtual events at ASB as well this year, and good attendance at the ones that I did. And like you say, it's quite nice how you can have some contact with people that otherwise probably wouldn't have been there. and it'll be interesting to see how we balance that in the future. I certainly really enjoy the face-to-face contact, and
same here, yeah.
But see some benefits as well. And you've talked about the benefits of getting better at online stuff for covering all the businesses that you have to analyse too. So this is, I guess 2022 might be the year where we're balancing out some of that virtual contact versus hopefully a bit more face-to-face.
Yes, yeah, hopefully.
Hopefully. I mean, I did you say that at the end of 2020? I certainly did.
Yeah.
And here we are at 2021 saying the same thing.
Keeps getting pushed out year after year.
yeah, the idea of the year, and maybe it'll happen next year. But hey, let's turn to the local share market. And with, we've got a few weeks to go, but we're down about 3% since the start of the year, whereas the Aussie markets is up 8% or more when I cut the numbers earlier this week, and the global share market by even more. So we really are out of sync, and there's a lot of factors behind this divergence. So let's chat about those. But equally important, hear your thoughts on the outlook for some of the stocks and sectors in the local market. So, hey, first up, winding the clock back a year, we were seeing Contact and Meridian share prices go through the roof and driving the overall market up due to that really high demand from exchange-traded fund buying, and then prices dropped off when that fund changed its weighting. That was the thing I remember about the start of the year. But how are those range of electricity companies, how have they gone through the year, and what's the outlook for them? They're really popular companies that have been good dividend payers for New Zealand investors. So what are your thoughts around that area?
Yeah, so I guess, jumping back to kind of what you said, the NZX has actually been a pretty challenging year this year for our market, and it's been the third worst performing developed market in the world, which is quite amazing. And it's been dragged down by mainly the large caps. So you've Meridian, Ryman, Contact, and A2 Milk as well. We have actually had earnings growth. So we've had about 7% earnings growth this year, which has been driven by those COVID beneficiary names. So with the market actually falling, we've had multiple compression. So this is the first time we've seen multiple compression in the New Zealand market since 2011. So in terms of the utility names, so the Contacts and Meridians, for example, like you said, this time last year, they were seeing this huge inflow in terms of what we call passive or index buying with one of the largest clean energy ETFs. And I actually had breakfast this morning with a broker who said, last year that they were keen for a pretty chilled out Christmas, New Year period, and then all this ETF buying came in Meridian and Contact, and it was just a really hectic time of year for them. So going back to that, that rebalance happened, and all that led to those names getting down weighted in the index and led to share price fall. So. And those names have underperformed the market for this entire year, really. Now Meridian, I guess that's down about 40% now, and that's off the back of a combination of, so we've got rising interest rates here in New Zealand, and then also that it's on a very high price to earnings multiple. So I guess looking forward, we actually we still really like the space in general. I think it's a particularly for me who runs I run a sustainability fund. These are two names that predominantly feature in their fund. And so with Contact, why we prefer this one is that it is the cheapest name in the sector from a valuation perspective. It trades on around kind of 12 times EBITDA, and it's got the highest and the greatest improvement in renewable share of generation over the next 5 years. So it's expected to get to about 90% renewable by 2024. It's also got a very attractive dividend yield, and the great thing about this is around Contact is that it has no government ownership. So it's kind of a sitting duck in terms of, from an M&A perspective. I guess historically that gentailers don't tend to outperform in rising interest rate environments, but I do think that there's a lot of valuation support, particularly in Contact. I guess this is why we kind of take a portfolio approach and we hold positions accordingly in terms of valuations and outlooks, but we are still pretty positive on this space, despite it having underperformed this year.
Yeah, I've sometimes thought the best way to look at these stocks is to cut out the mountain or the price spike and just look at how they've gone, and they still hold those characteristics of being good income generators.
Yes.
So, it's positive to hear your thoughts about that. Another thing that we get questions about, and it always troubles me a little bit and confuses investors, is the ownership structure and motivators within the dairy sector. I mean, if we look at dairy prices itself, we're forecasting a milk price for farmers this year of around $8.75 per kilo of milk solids, which if we get that, it'll be a record. So it sounds like dairy is good, but of course that's an input cost for the dairy manufacturers. And it hasn't been a good year for the dairy stocks on the NZX. How have you approached that, and what are your thoughts around the listed stocks like A2 and Fonterra, Shareholders Fund, Synlait, etc., that have been at the bottom end of the market performance this year?
Yeah. So like you said, it is a good environment for farmers, but there isn't many quality ways to play dairy on the stock market, which seems surprising for a country like New Zealand. So like Fonterra, for example, from our point of view, is pretty uninvestable just in terms of the structure. The structure is set up to benefit the unit holders or the farmers over shareholders. So from a shareholder perspective, we find it quite difficult to actually invest in that company. In terms of Synlait and A2, they've had a mountain of other issues going on, and they kind of move in tandem because A2 owns around 20% of Synlait. I guess with A2, it gets a lot of airtime. It was a market darling back in its day, and it has had a really tough, end of 2020 and the start of 2021 with all those inventory issues. So I guess taking a step back, it relied a lot on this Daigou channel, so Chinese people buying product in Australia and New Zealand and sending it over taking it over to China to resell effectively. And that was all well and good when when the sale revenue is growing and that demand is just getting bigger and bigger and bigger. But then when no travel was introduced, that just led to a huge unraveling of these inventory issues. It showed the lack of visibility that the management and the company had on that sales channel. And nobody was really asking questions when it was going well, but when that starts to unwind, they had significant amounts of inventory in the system which they had to get rid of, which meant led to price reductions, which led to possible brand damage in terms of that price point of the infant formula product. Then the communication that the management gave to shareholders and to investors was pretty lackluster. So that had been a significant underperformer this year for a number of issues. I guess looking forward, we're seeing a real increase in competition in the space, as well as there's been a lot of lack of babies being born in China during the pandemic, which is kind of ironic for me because I'm just seeing more and more of my friends are kind of bringing forward their baby plans rather than delaying them. So we're kind of seeing the opposite here in New Zealand and Australia, but over there it's the pandemic is an environment that you really want to raise children in right now, so they're delaying that. So they've got short-term issues and possibly more longer-term issues. So we're pretty skeptical on A2 milk at the moment, and just think there's better opportunities elsewhere for investors' money at the moment.
Yeah, it really highlights a difference between a macroeconomist approach like ours, where we look at what's the impact of what's going on here for the entire economy. So whenever we see something like very high commodity prices in dairy or in meat for that matter, we just straight away translate that to an income boost for the regions in New Zealand. But your comments really highlight that that doesn't necessarily mean when you invest in these companies that you're actually investing in the macro story. It's quite different.
Yes,
And the really interesting comments. And the good news from us from an economic perspective is just to see a really good rural income story for New Zealand, particularly when we know that one of the rural income streams, tourism, is probably still going to be fairly challenging over the coming quarters. So it's nice to think that they'll have confidence in what's coming in from the farm at least. Hey, now another theme we've discussed that you hinted at before is these COVID winners and losers. In other words, stocks that have benefited during the pandemic, like the stay-at-home businesses and healthcare stocks like Fisher & Paykel Healthcare. And then I guess we have the reopening winners and losers, for want of a better term, as well. So what's your core view you're taking on the economy reopening? And what does it mean for some of the big local companies that have had their outlooks changed so much for good and bad during the last year, and will change again over 2022?
Yeah, it's a good question. I mean, we've tried not to take a big swing either way in terms of kind of reopening or stay at home, because I guess what we've seen with Omicron, as soon as you take that swing, something comes up that reverses that. So we're trying to take a more balanced view in terms of the portfolios, just due to the uncertainty out there and the fact that we don't think it's going to be a kind of linear recovery. It's going to be a bit more bumpy. So we have taken advantage of market weakness, though, where we kind of think it's appropriate, like the last couple of days. But in terms of an environment with COVID, one that stands out is obviously Fisher & Paykel Healthcare. They did fantastically well during COVID. I mean, their sales really just follow hospitalisation rates in the US and Europe. So as we saw those peaking in 2020 and even in the start of 2021, their sales kind of followed suit. They actually had the result just the other week, and this company is now 15% of the index. So it does get a lot of attention from the market, as it should. But I guess because they provide the ventilation devices and masks to the hospitals, when we start to see those hospitalisation rates fall off a cliff, it does beg the question of okay, well, what does 2022 look like and beyond? And this has been the biggest question mark around the stock, and hence the kind of the performance has been pretty lacklustre this year. Because markets are forward-looking, and we've seen this huge pull forward in demand for their products. So you now got this huge installed base, which you need to then grow on top of again. And the market's forecasting, I think, about a 20% decline in earnings next year. But the consensus is very wide at the moment, whether that's -5 or -25. And that's on the back of a 100% increase in FY21. But I mean, this is one of New Zealand's most successful businesses. It's got a very high quality management team and a history of great executions. So that's kind of why it trades on over 50 times earnings. But so there is a bit of you back the management team here. But in terms of the underlying environment, it does look like there is quite a few headwinds for the next 12, 24 months for that business.
And in terms of companies like the airlines, the travel stocks, it's the same sort of thing that hey, if you took a big swing and thought this is all over, well then the likes of Auckland International Airport, Air New Zealand look good. But as we've seen even in recent weeks, you just can't do that because things keep coming along that change how strong the reopening will be for these companies.
Totally, and it is a case of with the Air New Zealands and Auckland airports, it is a case of when, not if. We will get back to travel, and I think we will get back to travelling in a meaningful way. But with these new variants, it just keeps getting pushed out and pushed out and pushed out. And they're now talking. We had a call with the travel company just yesterday, and they're saying, in Australia, no international travel. Significant international travel to 2023, and we'll probably be the same. So the earnings profile just keeps getting pushed out and pushed out and pushed out. And as an investor, you are long-term investors, but you start to find opportunities elsewhere, which are a bit more solid in terms of being able to see when that actual earnings recovery is. Auckland Airport has done fantastically well this year. It went from $10 before COVID down to $5, now it's back to $8. So it's nearly back at its pre-COVID levels. So there is a lot already priced in these kind of names, yet the earnings recovery keeps getting pushed out. So, it's a pretty kind of unattractive, in our opinion, kind of risk and return profile at the moment, just because there's so much already priced in. But we've definitely tilted the portfolio more to kind of value cyclical names versus growth, just in terms of that global reopening, an Australasian reopening story, because it is a case of kind of when, not if.
On a completely personal note, I got an email today that highlighted that an awful lot of roadworks had been done around Auckland Airport, so it was going to be easier when it did reopen for us to get out there, which is good, having put up with some pretty gnarly roadworks and cone action the last few times I could travel, which was over 100 days ago now, obviously. Hey, one of the things economists are still licking their wounds on about is the housing price boom we saw during the pandemic, in contrast with the declines we normally see in a severe recession. And low interest rates clearly were part of that. But now we're getting higher interest rates. It should cool suit things somewhat. But the construction outlook still looks really solid. And when we look at the latest building data for the third quarter, it actually looks like construction held up reasonably well during the latest lockdown as well. So what's your thought on how construction's panning out and what it means for the likes of Fletcher Building?
Yeah, well, Fletcher Building, it's been pretty weak, especially when we went into lockdown. We had no construction that was allowed, so that again just pushed out that recovery a bit, and it hasn't really recovered. It's had a good couple of days recently, but it hasn't really recovered since then. And we are hearing of significant price inflation in building products, cement, etc., which is positive for the likes of Fletcher Building because it's got such a monopoly position and can just easily pass those on. But then you've also got the supply chain issues, which is leading to shortages and it not being able to take advantage of those price increases as much as it could have. But like you mentioned, the stock market's forward-looking, and the market is becoming increasingly concerned about the impact of rising interest rates on demand, plus the record high consents in terms of supply. So, house price inflation has such a significant influence on consumer confidence, and in relation to that, the share price performance of these cyclical names like Fletcher Building. You'd also lump in the retirement names into that, so Somerset and Ryman. So, a lot of these names have been pretty weak in terms of because of those rising interest rates. But I think from an evaluation perspective, Fletcher Building does actually look quite attractive. And it's got about a 5% dividend yield. But, you do have to monitor that house price inflation. And if we start to see that coming off because of higher interest rates. And, we're constantly looking forward and thinking, how can this impact earnings?
Yeah, I think the construction sector and dairy, for me, go hand in hand with that earlier comment I made that just because economists are forecasting a phenomenal outlook for a particular sector, it doesn't necessarily mean that it's easy to invest in New Zealand, and Fletcher Building certainly had its ups and downs with that.
Yes.
So, but it looks like to us that we should still see plenty of cranes over the year ahead. And hey, let's jump across the Tasman because construction's been a big story over there. And as a portfolio manager, are you seeing opportunities over there relative to their construction, both in infrastructure as well as housing and residential?
Yeah, so I guess, like you said, we are seeing similar trends in Australia as well. Luckily, Fletcher Building, it's dual listed, and we actually hold it in our Australian fund. We hold the Aussie stock in our Australian fund, so we get the benefit of that as well. In the Australian fund. The other names over there, like James Hardie, that's done fantastically well, but that's more kind of US housing. But what we're actually seeing is a lot of the building products companies outperform in Aussie, similar to kind of to here in New Zealand, but Wesfarmers, so that owns Bunnings, Bunnings is going from strength to strength. And I think that's a bit around also you're stuck at home, you're doing your DIY, as well as the trade side as well, which is more resi construction. We actually had Metcash, which is which owns a whole lot of supermarkets in Australia, report their result on Monday. And they have recently acquired what they call Total Tools, which is like a Bunnings, but more trade focused. And that just blew the lights out in terms of its results. So we're really seeing a lot of strength in that kind of resi construction sector. And then, yes, like you mentioned, the more kind of commercial infrastructure side, all those names are again going from strength to strength as well. So we're really seeing it across the board in Australia as well.
Just sticking with Aussie, we've discussed this before, that there's some big differences between the two share markets that explain some of the divergence in performance, and in particular the nature of the commodities, the hard commodity resource stocks in Aussie, and the banking stocks that make up a huge part of the Australian market. So what are the themes you're seeing with those sectors, and is that behind some of the outperformance? Maybe starting with the banking stocks, how's that gone and what's your thought on the outlook there?
Yeah, the banks have had a great run. Like, obviously they weren't, people were quite sceptical, when COVID hit and how that would impact the banks and lending, and then it wasn't as bad as expected, and the banks have come out a lot stronger, in terms of their balance sheets, and they are in a much stronger position now than they were, 24 months ago. But with the banks, I think housing accounts for around 60 or 70% of the bank loan portfolios and Australian bank loan portfolios. So again, coming back to that housing price discussion, they do very much rely on kind of what happens in the mortgage market. And it's always been hard to call the top of kind of the Australian housing cycle, but we are seeing the headwinds, are growing, given higher interest rates. They've got looming kind of macro prudential breaks, and also the rising regulatory capital intensity over there as well. So I think, while there's capital management, which should remain a tailwind for banks, in terms of share buybacks, I think there's going to be some net interest margin headwinds going forward. So yeah, we could see some more share buybacks, which the market loves. And I think the banks is a tough one because they are such a large portion of the index. They're about 20% of the ASX 200. So you do, need to have a position, either way, whether you're kind of underweight or overweight, or and they do tend to, all four banks tend to kind of move and sink a bit. So I think there's a bit of a changing of the guard as well, in terms of some banks that have underperformed that are starting to do better now, and other ones that have done particularly well haven't produced such good results. So it's a tough one, but on the whole, I think, the risk reward definitely looks more muted going forward than it did. But then again, the strong GDP growth that we're seeing and kind of that economy reopening in Australia should help, support growth in the banks.
Yeah, I know firsthand from being inside one that when the housing market's busy, pretty much the majority of people and the banks will be busy. And the interest rates within our own forecasts are definitely a headwind to house price appreciation. The other thing which I think has been surprising and good news for the bank, which ties in with our earlier conversation, is just how much stuff everyone within the bank is able to get done within this environment, and that's just been staggering. So, the other difference that's key is the resource sector, which is so big for Aussie with those big hard commodity stocks. What are you seeing there, and what are your thoughts on the price outlook for some of these really important things, iron ore and coal in particular for Aussie?
Yeah, again, it's been a pretty volatile sector. We saw the resources names in general outperform, kind of the first half of this year, the first 6 months, and then the last couple of months, they've really fallen off a cliff as the iron ore price has as well. So, and that it really just follows commodity prices as you'd expect. So, when we saw increase in demand for commodities and iron ore from China in the first half of the year, then the resources names, significantly outperformed. Then China had its issues around concerns around property and what's going to happen there. And then we saw prices fall, and then the resources names share prices follow suit. Just the other day, we saw that China has started easing, which is a positive for the miners. But you're going from it effectively means that steel production it should be kind of less worse than expected. So it's still going to be, down year on year, but it's going to be less bad, I guess. So it doesn't mean that this is, China easing is going to lead to a significant rise in iron ore prices, and it is something that we do monitor, but it's pretty difficult, I guess, with getting visibility about what's going on in China, something that we've always kind of found quite difficult. But we think in terms of the stocks themselves and the resources names, they're pretty attractive from a valuation point of view. And so it's just a case of really trying to take a long-term view and time our entry and exit around the edges, as best we can, really.
It's, I guess if I think about my entire career, which has been very Australasian focused. We've talked about a China slowdown and property market bursting and what it means for Aussie resource stocks and for New Zealand companies in that matter. So in that vein, 2022 doesn't look any different from any other year in terms of those worries that a naysayer would bring up.
And I'm not a resources analyst, even though I have covered Australasian equities for years. Resources still do my head in, and I'm trying to outsource that to our resources analyst, who is much more across it than I am.
Leave it to Tama, right? He's been doing it for a bit longer. Hey, so we've had a combination of big picture views and some stock specific stories, which are really just fascinating for all of our investors, ranging from people trading shares on ASB securities through to people in our portfolios and other investments. So let's wrap up with just some big picture things. And so what's the thing you've found most interesting about the year that's been as one of the finishing questions?
Oh, good question. Yeah, I think it kind of comes back to kind of our beginning discussion, really, I think, is that I found most interesting this year is just how short-term focused the markets can get and how long-term focused we need to be as a fund manager. In order to generate alpha and to outperform, you can't be reactive. It's too late if you're kind of reacting. So you need to really take that long-term view, and just how important it is to invest in high-quality businesses, because they're the ones that are going to come out stronger. They're the ones that aren't going to have to raise money. They're going to be able to invest and continue to grow and build that kind of defensive position. So I think that's probably one thing that I've found the most interesting is just how short-term focused the markets can be, and how frustrating that can be from a fund manager's point of view.
Yeah, I think things have not only have they been short-term focused, and in my space, forecasting mortgage rates, in some cases they've needed to be, because the thing which has been most interesting for me has been the massive change in interest rate markets. And to your point, how quickly we changed our focus from COVID and it's all being hard and economies are going to underperform to inflation. And suddenly we've got mortgage rates that are over 2% higher than what they were at the start of the year. Inflation, interest rates, they all have a big impact on our customers, and it's been good to be able to help them on both fronts, particularly when things are moving so fast. And hey, on a personal note, in between lockdowns, I managed to get a commercial pilot's license, so that was a personal highlight for me. And so what's your focus going to be for 2022, do you think?
Well, I'm not getting my pilot's license, but go you. That's great. Is that so that you can leave the country while everyone else is stuck here?
Yeah. I'm going to become one of these people that fly desperate trans-Tasman travellers around.
I think for me, personally, I think I'm really focused on making sure I take a break. It's been a pretty crazy couple of years. Been in lockdown, haven't taken a lot of leave, and so I'm really looking forward to taking a break and doing some domestic travel, visiting New Zealand. Really making the most of, I guess, being stuck in New Zealand. But then I think professionally, I think I'm going to be focused on, just how, like you mentioned, just how markets and our companies that we invest in really navigate some of these kind of big macro changes, the rising interest rates and inflation. I think for me, I haven't had to deal with a sustained rising interest rate environment in my career. So I think it's going to be really interesting to see that kind of shift. And so, I'm really excited to kind of see how that plays out and try and navigate as best we can through this really, interesting kind of macro environment we're about to go through.
Yeah, I echo those thoughts, very similar thoughts for me. And hey, I thought that over my 30-year career I'd been through a sustained interest rate rising environment, but I realised when I look at charts going back to the 70s that actually we've all been in a falling interest rate environment. But given they nearly got to zero, it does feel like we've turned a corner. And yes. I'm pretty sure that after a few weeks break, I'll start 2022 with a wary eye on inflation and interest rate markets, that's for sure. And on a personal note, we're hoping that 2022 means a bit more family time and travel after not seeing parents and siblings overseas for a few years. So, hey, I'll wrap it up there and just say thanks a lot for your time and your thoughts. I hope you have a great break over summer and can join me again next year.
You too. Yeah, looking forward to it. Hopefully we can do the next one in person.
Yeah, sounds good to me. Okay, thanks a lot.
Thanks, Chris.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.